Under the current higher education system in England, students can borrow from the government in order to cover the cost of tuition fees and living costs. Students can borrow up to £9,250 in tuition fee loans, and on average around £6,000 per year in maintenance loans. The amount of maintenance loan depends on student circumstances, with higher loans from students from poorer backgrounds and higher loans for those living in London. Over the course of a 3-year degree, on average, students will borrow around £45,000. However, during studying, these students will also accumulate interest on this debt, currently charged at 3% plus RPI. As a result, when the average student graduates, they will have accumulated around £50,000 in debt. £50,000 is a lot of money, but what does this actually mean for graduates? Student loan debt is very different to, for example, credit card debt. Student loans are namely income contingent. What this means is that graduates only have to start repaying if they earn above a certain level, currently £25,000. If they earn more than £25,000, they will have to start repaying 9% of their income above this threshold. The rate of interest charged also depends on the level of earnings. It ranges from 0% plus RPI for those earning less than £25,000 and goes to 3% plus RPI for those earning more than £45,000. If the loan still has not been fully repaid after 30 years, it will get written off. We estimate that around 80% of students will not repay the full amount of their loan within those 30 years. What this means is that for those graduates, the system really works more like a marginal income tax than a loan. For example, if tuition fees were to double, these 80% of graduates would not have to repay a single pound more. Equivalently, if tuition fees were to decrease, this would still leave a significant proportion of graduates unaffected.